Hi, and welcome to another presentation from your business tutor, learning your way, anytime, anywhere. When it comes down to it, at the heart of business is the concept of profit. This is because profit is what makes a business sustainable in the long term, in that without it, a business will not generate enough money to convince the owners to carry on. This is why this presentation on income statements is so important, as it is through this document that a business calculates how much profit it has made. So what are we going to learn in this presentation? Well, first of all, we're going to find out what an income statement is. Then we're going to discover why organisations prepare income statements. And then finally, we're going to explore how an organisation can increase its profits. Okay, before getting started, it is probably best to clarify a concept we will mention a number of times during this presentation, and that is, what is profit? Profit is the money a business earns from selling its product minus the costs of running it. Put simply, this means profit equals total sales revenue minus total costs. This is a really important principle, because it tells us that profit is the return or reward the owner or owners of a business earn for taking on the risk of starting a business. In fact, it is through the profits that a business makes that the owners will earn a return on the money they invested in the business to start it up. Okay, let's now move on to find out how an organisation calculates how much profit it has made by asking, what is an income statement? An income statement is a financial document that calculates how much profit a business has made from buying and selling inventory minus the expenses of running that business over a certain period of time. Now, although this definition is incredibly succinct, it would be fair to say that anyone new to business may struggle with understanding what it actually means. Given this, it would seem sensible to explore in more detail what an income statement is, by looking at how one is prepared. So with that, let's start by investigating the first part of the definition, which referred to the buying and selling of inventory, which, when you think about it, is at the heart of making a profit. For example, if a business buys an item of inventory for £5 and then goes on to sell that item for £15, it will have made a profit of £10. In fact, this profit made from buying and selling inventory has a specific name and is referred to as gross profit. However, as simple as this concept is to understand, it must be appreciated that so far we have looked at a situation where only one item of inventory has been bought and then sold. In reality, a business will buy and sell hundreds, if not thousands of items of inventory every year. And therefore, we must understand how that affects how an income statement is prepared. For example, if a business were to buy 10,000 items at £5 each, it would cost them £50,000, which in an income statement would be referred to as purchases, the amount spent on buying inventory to sell to customers. Of course, if you think about this further, purchases can also be considered as a cost of sales, in that a business has to spend money on purchases before it can make any sales. This therefore leads us on to the next part in the process, which is the selling of the 10,000 items of inventory at a price of £15 in order to generate £150,000 of what is called sales revenue, the money a business earns when it sells its inventory to customers. From here, all the information can then be pulled together by first deducting the cost of sales or purchases from the sales revenue in order that gross profit can be calculated, which in this case, as the example shows, is £100,000. Next, the bottom half of the income statement can be completed by deducting the expenses of running the business from the gross profit. For example, in this instance, £15,000 is spent on staff wages, £2,000 on electricity and £8,000 on rent, which when added together comes to a grand total of £25,000, which when deducted from gross profit gives an overall profit referred to as profit for the year of £75,000. In other words, the profit a business makes from buying and selling inventory minus the expenses of running it. So pulling the whole thing together, and what you get is a complete income statement with sales revenue at the top, from which the cost of sales is deducted to calculate gross profit, and then from which expenses are deducted to calculate the profit for the year. Okay, so now we know how an income statement is prepared. Let's now go on to explore why organisations prepare income statements. As was stated right at the beginning of this topic, business owners or entrepreneurs go into business to earn profit. This therefore is the first reason for preparing an income statement, as it is through this process that an organisation can calculate if it is making enough profit to reward the owners for the risk they have taken on by investing in a business. This is a crucial point, because if the level of profit earned by a business is very small, or in fact a loss is being made, it may signify that the business should stop trading, because the owners are not earning a large enough return for the risk they have taken on. Another reason, which is somewhat related to the first, is that by looking at the different elements of the income statement, a business will be able to identify where it is strong and where it is weak. For example, if gross profit is high, but the business is making a loss for the year, this might indicate that the business's expenses, such as staff wages or rent, are causing a problem. In fact, this type of analysis can be even more effective if sales revenue, gross profit, expenses and profit for the year figures are compared from year to year to identify trends in performance. This, of course, all links to another reason, in that by looking at the different elements of an income statement, management will have some really good information to support any decision making on how to improve the financial performance of the business. For example, if gross profit is shrinking from year to year, it may suggest that the business needs to find a cheaper supplier to reduce their purchase costs. However, although there are many internal reasons for preparing an income statement, there are also a number of external ones as well. For example, by law, companies must prepare an income statement that should not only be available for public inspection, but which will also be used to calculate how much corporation tax it should pay on its profits. And finally, preparing an income statement will also be necessary should an organisation wish to obtain finance from a bank. In that, a bank will want to see if the business has the financial strength and profits to repay the loan before providing one. Okay, let's now go on to explore how an organisation could increase its profit for the year. As can be seen from the income statement, there are three main ways in which a business can increase its profit for the year. Either by increasing its sales revenue, decreasing its cost of sales, or reducing its level of expenses. Let's look at each of these in turn by first considering how sales revenue could be increased. One way in which this could be done is by running a highly effective advertising campaign that convinces customers to buy more products. Alternatively, a business might increase the price of their product, and if customers continue to buy it in the same numbers, sales revenue would also rise. Of course, sales revenue could also move higher if the business were to reduce its prices and a huge number of customers switch to them from competitors. Okay, let's now look at how the cost of sales could be decreased to increase profit. Probably the best way this could be done is by finding a cheaper supplier of inventory. However, if this is not possible, purchase costs could be reduced by buying inventory less frequently, but in greater bulk from your current supplier, meaning the cost per item would be lower. Okay, let's now turn to our last way of increasing profit for the year, and that is by reducing expenses. There are several ways in which this could be done, but in general, one or a combination of the following costs could be cut to improve profit: staff wages, rent, insurance, electricity, or heating. So what did we learn in this presentation? Well, first of all, we found out what an income statement is. Then we went on to explore why organisations prepare income statements, and then finally we investigated how an organisation can increase its profits. There is no doubt that using an income statement to calculate profit for the year and then analysing the information contained within it is incredibly important to business success. This is because when it comes down to it, a business that understands its numbers has a much better chance of making a profit and knowing how to increase them.